everyone, thank you so much for joining. In this video I would like to give you a very simple and easy to understand overview of how the different financial statements are linked and how they interact with each other. I know there are many videos out there where people explain it in Excel, how different balance sheet account interact with the income statement and with the cash flow statements. Sometimes I find those videos quite complicated, so I want to give you a very easy introduction. In general, there are 4 financial statements. First one is the balance sheet, is always in point in time. So for example, balance sheet 31st December 2024. Many items, I have recorded different videos that explain exactly what the balance sheet does. Usually what you can see is beginning cash, and beginning retained earnings. Why do I say beginning? In this balance sheet, you would use the cash position and the retained earnings, but if you look at balance sheet 2025, and then in particular cash flow statement, income statement, and statement of shareholders' equity, then you would use the ending cash from this balance sheet as your starting cash for this period, for this thing. And then you have a new ending cash here, ending cash, and ending retained earnings, and then your ending cash for the next period would then be your beginning cash. Yeah, so just don't get confused. Why am I using the old balance sheet and call it beginning cash? It's because the cash position in your balance sheet as of 31st December 2024 will be your beginning cash for the next period. Yeah, then let's start with the income statement. Just get rid of this, I think I need more space. Start with the income statement very briefly. Again, income statement, quite important, is 1st January 2025, potentially not on the 1st because it's a public holiday, and then 12 2025. So income statement covers a period, whereas balance sheets, they cover only a point in time. As you know, revenue, cost of goods sold equals gross profit or gross margin minus SG&A. Then you have your EBIT. I'm not going into detail, you know, depreciation, amortization, but then you have your operating income, sometimes called EBIT, operating income. Then you have your interest expense. Then you have your taxable income. And then minus tax expenses. And then you have your net income or earnings. I use the word earnings here quite often because then the retained earnings part makes sense. So this is what is left over, bottom line, net income. Then we look at statement of shareholders' equity. And again, statement of shareholders' equity is a period of time, similar to the income statement from beginning of the year to the ending. And your statement of shareholders' equity always starts with beginning retained earnings. And this is the first connection that we have. Beginning of retained earnings basically comes from your balance sheet. So you have beginning of retained earnings goes in here. Then what you have is, then you add net income. Net income, as you can see, comes from here. Then what usually happens if the company decides to pay out dividends goes in here, and what is left over is ending retained earnings, which then goes, if we go up, goes in here. Yeah, so this is the first connection between income statement and balance sheet, is the retained earning portion. Retained earning plus net income of this period minus dividends equals ending retained earnings. If we look at cash flow statement, and here I want to simplify again, we have beginning cash plus or minus cash flow from operating activities plus or minus cash flow from investing activities plus minus cash flow from financing activities, and then you have ending cash. Ending cash, again, as you can see, goes in here into your balance sheet. Beginning cash goes here. And then there are more links, which we will learn at a later stage. Net income will also be part under your cash flow from operating with some additional adjustments. And then your cash flow from financing is usually also connected here to your interest expense section. Yeah, there are some other connections, but I think just to give you a brief overview, this is a good starting point. Main part here, whenever you compare balance sheet items with income statement items, just ensure you use either an average or really look at what is actually driving. So if you have a certain asset amount, 100 here, 200 here, don't compare your revenue. If you want to calculate an asset turnover ratio, don't use 200 with your revenue, either use 150 as a kind of average, or if your statement is that you believe those initial assets were responsible for the majority of the revenue in this year, then you can use 100, but just be mindful of whenever you compare balance sheet numbers with income statement, cash flow, or statement of shareholders' equity numbers, that balance sheet point in time figures, whereas the other three financial statements cover a period of time. Good, thank you so much for watching. I hope you found this useful. See you in another video.